Marcus was 28, working as a software developer and finally ready to start investing. He had $5,000 saved up and was eyeing two stocks. One was priced at $15 a share, the other was $300. He figured the $15 stock was the better deal. It was cheaper, right? Wrong. That thinking nearly cost him a year of savings. The single number he was missing? The PE ratio. Today, we're going to break down exactly what that means and how understanding it can help you invest smarter starting today. PIE stands for Price to Earnings Ratio. Here's the simple formula. Take a company's current stock price and divide it by its earnings per share, or EPS, which is basically how much profit the company makes for each share of stock. So if a stock costs $50 and the company earns $5 per share, the PE ratio is 10. Think of it like this. You're paying $10 for every $1 of profit the company generates. This is exactly what Marcus didn't know when he was staring at those two stocks. It's not about the sticker price, it's about what you're getting for that price. Remember Marcus's two stocks? Let's run the actual numbers. The $15 stock had earnings of just 30 cents per share, giving it a PE ratio of 50, meaning Marcus would pay $50 for every single dollar of profit. The $300 stock? It was earning $30 per share, a PE of just 10. So which one was actually expensive? The $15 stock was 5 times pricier in terms of what you get for your money. This is the insight that flipped Marcus's thinking completely. Price is what you pay. Value is what you get. Here's some important historical context. The S&P 500's average PE ratio has typically hovered between 15 and 25 over the long run, with a historical average closer to 16. But as you can see, it swings dramatically. During the dot-com bubble in 2000, it spiked to nearly 45. It dropped sharply during the 2008 financial crisis, and it surged again during the pandemic recovery. This chart shows why PE ratio alone isn't a perfect crystal ball, but understanding where we are relative to history gives investors important context. Marcus used this chart to understand that timing and market cycles matter. So how do you interpret PE numbers in the real world? Think of it in 3 rough zones. A PE below 15 may signal the stock is undervalued, though there could be reasons the market is skeptical. A PE between 15 and 25 is historically considered fair value territory for the broad market. Above 30 means investors expect significant future growth. You're paying a premium for that potential. But here's what Marcus learned the hard way. Always compare PE ratios within the same industry. A PE of 35 is normal for a high-growth tech company, but alarming for a slow-growth utility company. Context is everything. This is the chart that truly opened Marcus's eyes. Look at how differently PE ratios vary by sector. Technology companies often trade at PE ratios above 30 because investors expect rapid future growth. Financials and energy companies tend to have lower PE ratios, not because they're worse businesses, but because their earnings are more predictable and growth is steadier. Healthcare sits in the middle. This is why comparing Apple's PE to a bank's PE is like comparing a sports car to a pickup truck. Both are vehicles, but built for completely different purposes. Always compare apples to apples. Here's a number worth sitting with, 24. That's roughly where the S&P 500's PE ratio has been sitting as of 2024, meaningfully above the long-run historical average of around 16. This doesn't mean a crash is coming. Markets can stay elevated for years, but it does mean investors today are paying a premium for future earnings. When Marcus saw this number, his next question was exactly the right one. Does the growth justify the price? That's the right mindset. PE doesn't tell you what to do, it tells you what to think about. There's one more layer Marcus discovered. Not all PE ratios are the same. The trailing PE uses actual earnings from the past 12 months. It's based on real, reported numbers. The forward PE uses analyst estimates of future earnings. It's more speculative, but gives you a sense of where the market thinks a company is heading. If a company's forward PE is much lower than its trailing PE, analysts expect strong earnings growth ahead. Marcus started checking both. Trailing tells you where the company has been. Forward tells you where investors think it's going. Neither is perfect, but together they tell a much better story. Here's where Marcus almost made his second mistake, treating PE as the only number that matters. It's a powerful tool, but it has real blind spots. A company can have a great PE ratio but be buried in debt, which changes the risk picture completely. Earnings can also be temporarily inflated by one-time events, making a company look cheaper than it really is. And for high-growth startups with no profits yet, think early-stage tech companies, the PE ratio simply doesn't apply. Savvy investors pair PE with other metrics like debt-to-equity ratio, price to sales, and free cash flow. PE is the starting point, not the finish line. So where is Marcus today? He invested that $5,000 thoughtfully, using PE ratios as one tool among several to evaluate his choices. He avoided overpaying for the flashy cheap stock and found genuine value in the one with strong earnings. 3 years later, his portfolio has grown to over $9,000. Not because of luck, because he started asking better questions. The PE ratio won't make you rich overnight, and it's not a guarantee of anything, but it gives you a lens to see past the sticker price and ask what a stock is actually worth. That's the foundation of intelligent investing. This is for educational purposes only. Always consult a financial advisor before making investment decisions. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Past performance does not